These are confusing times, so hopefully we can provide some definition to buzzwords such as volatility, escalation, and inflation. I suppose my personal definition would be that volatility would be represented by the difference between our bid dots and the Vermeulen index green line, and that the Vermeulen index shows the escalation roller coaster of our database, and the straight line long-term average trend lines for the construction or consumer prices represent inflation, essentially broadening out from micro events to macro average trends. Let's look at information from the AGC, Associated General Contractors, which uses pre-pandemic levels as their baseline. As expected, employment took a big down spike due to stay at home, then recovered over the next few months. Construction recovered quickly as most work continued. Residential is now adding jobs over pre-pandemic levels, while non-residential is paused due to uncertainty in several major non-residential sectors. Again, using pre-pandemic as the baseline, we see non-residential construction employment levels slightly lower. It'll be interesting to see how post-pandemic migration and demographics play out. Will Idaho and Utah continue to attract work from home? Will high-cost financial centers like New York continue to cool? AGC data shows a liftoff in Q2 for bid prices. The AGC database uses warehouse bid prices, which have been very strong through the pandemic. Our advice during Q2 to carry a 4 to 5% bidding contingency covers upward volatility for both the cost push of input prices, up 26%, and selling prices in busy markets. Warehouse bid volumes and prices have been strong through the pandemic. The light blue index shows lower inflation in this sector due to the higher productivity gains of standardized construction. Our data is comprised of custom, institutional, commercial, industrial construction, which almost by definition makes lower productivity gains relative to the construction sector and overall economy. This, contrary to the headlines, is a good thing. It means labor is increasing its purchasing power in the overall economy and the construction sector. Focusing in on selected inputs, this graph shows cumulative changes as opposed to spot prices. It shows the cumulative effect of cost increases absorbed by contractor bids over the span of the pandemic. Over the long term, either these prices come down and relieve upward pressure on bids, or less efficient bidders will leave the market. These periods tend to be short-lived. The financial crisis shows how spikes in commodity prices were quickly followed by surpluses during the 2000 to 2009 period, 2007 to 2009 period. After work volumes crashed in 2009, more stable commodity prices eroded margins again over a 2-year period. Today, as the pandemic eases, the expectation is for supply levels to rebound. This will play out industry by industry, depending on global trade conditions and local factors. Other indexes in our sector, such as Turner Construction, show an increase in Q2. However, from Q1 2020 to Q2 2021, the Turner Index agrees with the flat levels contained in Vermeulen's index. The liftoff does correspond to an increase in quoted prices we are seeing in pre-contract estimates, as well as significant increases in contract rates in busy markets. As backlogs rebuild in some sectors, and as attrition plays out, contractors will be able to reestablish margins. This will accelerate as payroll subsidies taper off. As shown in previous forums, the financial crisis laid bare many weaknesses in the supervision of our financial system. But one of the great successes of our generation, the crisis yielded not only a highly sophisticated set of stress tests and regulatory authority, but a culture of transparency and interagency collaboration that characterizes our financial discourse today. This new normal goes beyond rules and definitions to create an ever-evolving environment of checks and balances. Recently, We can see it here in the willingness of the Fed to redefine their mission and methodology for both employment and inflation in reaction to a real-time course of events. Let's look at what this means for employment. The Fed will continue to provide stimulus because the new normal says that the Fed will act until there is evidence, as opposed to expectation, that employment growth is too strong. Previously, if the unemployment rate reduced, the Fed would tighten to ward off a potential rise in inflation. To quote the Fed, the process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust. With maximum employment, there isn't a single number that we can target. We monitor unemployment, participation, wages, flow data, etc., to try to arrive at a picture of what is maximum employment. While prices will likely tick up, inflation will need to exceed the 2% long-term target for some time in order to move the long-term average up. Therefore, our projections coming out of this pause in price levels is for significant escalation to recoup margins and bring supply growth back to normal and beyond. Significantly, the Fed will not react to what they consider one-time increases in prices. As with the rapid drop in oil prices in the first stages of the pandemic, these price movements smooth out over time. Again, to quote the Fed, current inflation is running well above our 2% objective and has been for a few months and is expected to run up before we believe it'll move back down toward our objective. This inflation is not spread broadly across the economy. It's new and used and rental cars, it's airplane tickets, it's hotels, and it's a couple of other things. And each of those has a story attached to it that is really about the reopening of the economy. Those are temporary things because the supply side will respond to the economy and the economy will adapt. So we think that inflation should move down over time. This chart shows the new normal very clearly. The old regime of rising interest rates in the face of asset bubbles leading to the financial crisis, then the unprecedented reduction in interest rates and increased quantitative measures, then a measured stepped rise in investment and asset prices, finally increases in interest rates. Then with the pandemic, a whole new immediacy came to both rate reductions and ongoing quantitative measures. Fiscal and monetary measures working in tandem to support price levels in the face of a shock to both employment levels and the fundamental structure of the economy. This is truly new. The old normal said that hard currency had to be constant, while credit could boom and bust. The new normal uses fiscal and monetary measures in concert to control a broad array of prices and growth conditions.